All right. Well, thank you for joining. We're going to wait a couple more minutes and allow for more folks to join. Um, I will mention for those who are on right now, there is a Q&A box being monitored during the session, so feel free to use it and ask questions. I see a few more people joining. Just a reminder, we're just holding off a little bit so some more people can join. And again, just a reminder, Q&A box being monitored during this session, so please use it. Feel free to ask any questions that come along. All right, so I think we'll look to get started now. Hello, everyone, and welcome to today's featured webinar, The Psychology of Investing, How Our Brains and Hearts Can Play Tricks on Us. My name is Steven Zaharchik with the Mahoney Group of Raymond James, and I'll be speaking to you all on the topic of behavioral finance. Before we jump into things, I would like to highlight a quote here on the screen by the famous investor Benjamin Graham. His quote, "The investor's chief problem, and even his worst enemy, is likely to be himself." Let's keep this all in the back of our mind as we go through this session, as we'll aim to equip you with the foundational understanding of behavioral finance and its implications for investment planning and really getting you to and through retirement. So my hope is to share with you all three key components that first, to introduce the concept of behavioral finance and how it differs from traditional financial theories. Second, to identify common psychological biases that can negatively impact retirement saving decisions. And third, to provide you with actionable strategies that you all can use to make smarter choices regarding your investment choices and savings for retirement. So hopefully by the end of this webinar, you'll be able to recognize some of your own behavioral tendencies, understand how these can influence financial outcomes, and apply best practices to optimize your saving strategy. We've designed this to be somewhat interactive and, of course, informative, but by explaining real life examples and using some practical tools, we're looking to help each of you take control of your financial future. So before we begin, let's into the definitions at least, let's play a game. All right. So please take a moment to look at your screen and answer the following questions. On the left side, which of the gray circles is larger? In the middle, which of the gray bars is longer, the top or the bottom? And then on the right side, are the gray horizontal lines angled or are they straight? And I'll give you 10 seconds to come up with your answers. All right. So now you can kind of see the image has changed. The viewpoint, at least, has changed slightly. And you can see some possible differences in what your answers may have been. Let's review the first image. Which of the gray circles is larger? Well, while one may appear on the top to be larger than the bottom, in fact, actually, both are the same exact size. Now, when looking at the middle image, which of the gray bars is longer, the top or the bottom? Most people would have claimed the top is longer when in fact it's not. The two bars are actually identical in length. And lastly, on the right are the gray horizontal lines straight or crooked? While they do look angled in the previous image, they are actually in fact straight. So what was the purpose of showing you this? Well, when these images are presented in a new format, our perceptions have changed. This tells us that we can't rely on our perceptions, intuition, or gut feelings alone. Time and time again, investors often rely on their perceptions, making the same investing mistakes repeatedly. Fortunately, studies by some of the leading academics in the field of behavioral finance have shown that investors' irrational behavior tends to be systematic. Virtually everyone reacts the same way when placed in certain situations. And since they do this systematically, it's possible to explain why they act in this manner. So, to that point, it tells us that illusions, or better yet, biases, must be identified early, and we must try our best to appropriately counteract them. So, what is behavioral finance? A brief explanation, I suppose, is it's a field that combines insights from psychology and economics to understand how individuals make their financial decisions. Unlike traditional finance, where it assumes that people are rational actors who always make decisions in their best interest, behavioral finance acknowledges that emotions, cognitive errors, and social influences often lead to irrational behaviors. For example, people may avoid investing in stocks due to the fear of loss, even when historical data suggests they may achieve longer gains. Behavioral finance explores these tendencies and provides frameworks to mitigate their impact, not completely avoid them, right? Because again, we are human. But these key concepts include heuristics or mental shortcuts, biases like overconfidence and loss aversion, and the role of framing in decision making. So ultimately, understanding behavioral finance is crucial for retirement planning because it helps individuals recognize and or correct behaviors that could undermine their financial goals. By identifying or recognizing these behaviors, you can essentially put yourself in a better position to make more informed and effective decisions about your retirement contributions, your investment choices, and ultimately long-term planning. So, as I just mentioned, why is this important, particularly in retirement planning, is because the decisions are complex, long term, and emotionally charged. Many individuals struggle to save adequately for retirement due to biases such as present bias, which prioritizes immediate gratification over future benefits. Others may fall prey to loss aversion, avoiding investments that carry perceived risks, even then when the offer of return is higher. And again, these behaviors can lead to suboptimal outcomes, such as insufficient savings, poor investment diversification, and missed opportunities for growth. But again, by understanding the psychological factors that influence financial behaviors, um, these an investor truthfully can take a proactive step in improving their retirement readiness. Uh, this includes setting realistic goals, um, automating your contributions, and ultimately seeking professional guidance when needed. It's always good to have a soundboard or someone to talk to. Behavioral finance also informs plan design features like auto enrollment and default investment options, such as target date funds, which kind of counteract the inertia or resistance to and ultimately encourage better saving habits. And again, ultimately, integrating behavioral insights into retirement planning empowers you as the individual to make smarter, more confident decisions about your financial future. So, with behavioral finance, the opposite is the traditional finance. This is built on the assumption, again, that individuals are rational and that markets are efficient. It suggests, again, people make decisions based on available information, aiming to maximize their utility and minimize their risk. However, again, in real world behaviors often deviate from these assumptions. behavioral finance challenges these views by incorporating those psychological factors into financial decision making. Uh, as I mentioned before, it recognizes that people are influenced by emotions, cognitive biases, and social pressures, which again can lead them to make those irrational choices. For example, traditional finance would expect individuals to invest consistently based on their risk tolerance and time horizon. But again, because of behavioral finance shows that fear, overconfidence, and a herd behavior often disrupts the process. So understanding the differences between these two approaches might help you either appreciate the complexities of financial behaviors and the importance of the designing of your retirement plans, and also account for the human tendencies that are involved. Blending the two traditional financial principles and behavioral insights, again, you as the individual can make an effective strategy and manage your retirement savings better. So let's take a moment to just review some of the common biases individuals are susceptible to. First, we have loss aversion, which refers to the tendency to fear losses more than valuing equivalent gains, ultimately leading to overly conservative investment choices. Present bias causes individuals to prioritize immediate rewards over future benefits, resulting in undersaving for retirement. Overconfidence leads people to overestimate their financial knowledge and take excessive risks. Anchoring, of course, occurs when individuals rely too heavily on initial information, such as a purchase price or prevailing price. And mental accounting involves treating money differently based on its sources or intended use. We have a few more. Herd behavior describes a tendency to follow the crowd, often without independent analysis, which can lead to poor timing in investment decisions and may not revolve around your specific goals. And lastly, exponential growth bias causing individuals to underestimate the power of compound interest, discouraging early saving. So let me just remind you, it is important trying to just recognize the biases. That's the first step to mitigating their effects. So with that said, let's just jump into a few of these more in depth. Loss aversion is a pretty powerful psychological bias where, again, individuals experience the pain of loss more intensely, two times actually, than the pleasure of the equivalent gain. So in that context of retirement planning, this bias can lead an individual to avoid investing in equities or other growth oriented assets due to fear of market downturns. As a result, they may choose overly conservative investments, such as money market funds, which offer lower returns. And really, your biggest enemy is inflation. It may not keep pace with that. This behavior can also significantly hinder long-term retirement savings growth, um, coupled with the fact that people are living longer and money has to last longer. This is a pretty important one. The loss aversion also contributes to panic selling during market volatility, locking in losses and missing out on potential recoveries. Uh, we say it's not so trying to time the market, but time in the market is your best friend. So to counteract the bias, you should attempt to focus on the long-term investment horizon, diversify your portfolio, and that should help hopefully avoid making the wrong decision based on short-term market movements. Of course, education and professional guidance can help an individual understand the risks and rewards through different investment options. But I'd say a good advisor becomes a soundboard for you in the difficult times, ultimately enabling you or each other to make a more balanced choice that supports your retirement goals. The present bias refers to the tendency to prioritize immediate gratification over future benefits, right? We all need to spend money now, but there's some things that maybe we don't need right now, like the newest iPhone or the next new clothing line. So this bias can lead to individuals to delaying saving for retirement, again, opting to spend the money now on their current needs or desires. Again, in terms of planning for retirement, this bias manifests as low contribution rates, missed opportunities for employer matching. That's a big one. Reluctant to increase deferral percentages, right, as maybe your salary even grows. So an individual can recognize the importance of saving, but struggle to act due to the perceived sacrifice of current income, right, or even the stuff that you may want now. Overcoming present bias requires strategies that make saving easier and more automatic. Features like auto enrollment, auto escalation help individuals start and increase contributions without requiring active decisions. So, framing retirement savings as a future reward and using visual tools to illustrate long term growth can help motivate individuals to prioritize this savings. And by addressing this bias, you can build a healthier financial habit and improve your chances of achieving retirement readiness. This one's a little newer, and I kind of actually stuck it in here. Infobesity and short attention span. Um, this can mean people are making decisions too quickly based on the fear of missing out, FOMO for short, for those who know that acronym, or that there's so much information available, they may default into doing nothing at all. And again, speaking of shorter attention spans, thanks to modern day technology, I jokingly say that I hope I haven't lost any of you yet. But again, so to kind of avoid or get around this is having conversations or thought around your own needs is a good way to counteract, and formulating and sticking to your own long-term plan, and putting the phone down maybe once in a while. Next, we have overconfidence. This is a bias where individuals overestimate their knowledge, skills, and or abilities to predict outcomes. Spoiler alert, no one has the crystal ball. So in retirement planning, this can lead to risky investment behaviors such as frequent trading, lack of diversification, or even ignoring professional advice. Overconfident individuals may believe they can time the markets or select winning stocks, often resulting, or actually, excuse me, not as often, and resulting in suboptimal performance. So this bias is particularly concerning um, as cognitive abilities may decline with age, making it harder to manage complex financial decisions. Um, to mitigate overconfidence, one should really consider seeking advice from a financial advisor or professional, and regularly reviewing their portfolios, making sure that they're aligned with their long-term goal. Again, educating about market dynamics and historical performance may help temper unrealistic expectations, and recognizing the limits of one's expertise. Um, Relying on it, planned investment strategies can lead you to a more confident, not overconfident, retirement plan. So here we have another pop quiz time to get you engaged. On the screen here is a shoe. It's priced at $199. So my question to you is, would you buy a pair of shoes for $199? Some would say yes, some would say no. But let me ask the question in a different frame now. Would you buy the same exact pair of shoes that instead were initially priced at $500, but then discounted to $199, that same price? I think a lot more people would now buy the shoes because it's at a steep discount. This is anchoring. Anchoring is when individuals rely too heavily on their initial information, such as the stock's price, when making those financial decisions. Coupled with mental accounting, that involves treating money differently based on its sources or intended use. That can also lead to irrational behaviors. The anchoring effect may cause individuals to hold on to underperforming investments because they're fixated on the original value. And the mental accounting portion of it can result in inconsistent saving habits, such as contributing more from a bonus than regular income. You kind of think of it all as one bucket instead. Um, these biases hinder optimal financial decision making and can reduce the effectiveness of retirement savings. And ultimately, to overcome, I think both of them, you should focus on the current and future value rather than past prices. Diversification, regular portfolio reviews help maintain that balanced investment strategy. Treating, like I said, treating income all as part, a unified plan instead of separate buckets per se, and making those consistent contributions to your retirement goals. Um, Look, at the end of the day, you can be more rational in your decision making. Here we have a lot of sheep, but herd behavior. It's the tendency to follow the actions of others without independent analysis. So, in financial context, this can lead to investments decision making based on popular trends, or opinions for that matter, rather than your own personal goals and or risk tolerance. Herd behavior may result in chasing those high performing funds, buying into those meme stocks you hear of, or selling during market downturns because everything seems so um, doom and gloom, or simply just mimicking your colleagues' choices without understanding why they're investing the way they are. Again, they can undermine your portfolio's decrease its volatility or risk. I think to counteract the herd behavior, one should really develop a personalized investment strategy based on their own financial objectives, time horizon, and risk tolerance. Again, educating folks about market cycles, historical data can kind of help resist the urge to follow the crowd and encourage independent decision making by speaking to a professional and mitigate the impact of uh, herd behavior. Last but not least, we have exponential growth bias. This actually happens to be my favorite. Why? Because it's so simple yet the hardest to commit to. Exponential growth bias is the tendency to underestimate the power of compound interest and to assume a linear path to investment growth. Albert Einstein quotes it as the eighth wonder of the world. Um, this bias can discourage early savings as individuals fail to recognize how small contributions can grow to significant amounts over time. In retirement planning, exponential growth bias may lead one to delay enrollment or contribute minimally, missing out on years of compounding. The benefit of starting early and illustrating growth through visual tools can help overcome this bias. And of course, I have one for you right here. So I'll ask you a pretty straightforward question of, would you rather receive a penny and have it doubled in value over 31 days or receive $5 million right now? Well, if you choose the route of doubling your money each day, you would end up with almost $11 million by day 31, far exceeding the $5 million that was offered. And I think that's just a really powerful tool. And the power of compounding your money is something that's highly underestimated. So I'll just share with you all this image here, what we call the emotional investment roller coaster, as it shows the different phases of an investor's emotional experience. As confidence builds, there is a point of euphoria. And at that time, when things may seem all too good to be true, they sometimes are. We consider this to be the point in time when it's the most riskiest to be in an invested perspective. Why? Because inevitably we come to a point where markets go through periods of pullbacks or declines. And during this time, it may feel the hardest to be an investor. We view this as an opportunity as eventually markets do normalize and begin a new growth path. On average, bull markets tend to be longer and greater than bear markets. So keep that in mind. Consider diversifying your portfolio, continuing your contributions, keeping a long-term perspective, and staying your course. So to wrap this up, I would kind of like to finish where we started with the quote from Ben Graham: "The investor's chief problem, and even his worst enemy, is likely to be himself." So again, we recognize it's human nature to feel emotional about your money, but ultimately is essential to manage your emotions. So I hope that all of you can leave today with new insights and recognize a bias or two of your own, and ultimately look making a way for a life well planned. So thank you for your time. And if there are any Q&As, again, we'll keep the chat open for a little bit. Feel free to put them in there.
Steve, I do see a question here. This is your colleague, Kristen Kolish. For those who are on the line, many of you I've spoken to in the past. I'm a teammate of Steve's, and Steve and myself, along with Kevin Mahoney and Tom Small, are your team of advisors that services your organization's retirement plan. And even on topics other than what Steve covered today, feel free to reach out if you have questions about your personal investing strategy or retirement plan. I do see a question here about the current market. You know, what biases do you think the current market environment lends itself to? And how should investors be thinking about their portfolio today?
Yeah, I think a lot of it again revolves around your own individual planning. But kind of what I mentioned, that roller coaster, the point of euphoria, right? I don't think it's never not a bad time when things are really good, when things are above average, right? To kind of rebalance your portfolio, right? Back to its target asset allocation. That's just a healthy method to kind of keep your portfolio in check and you yourself in check, right? So trimming some from the winners, maybe adding to the not so goods, but keeping your balance intact and revisiting to the high watermark, right? If things were to pull back, right? If markets were to go down, would I still be okay? So again, I obviously encourage you all to kind of speak with someone that can kind of be a soundboard for you and just discuss what your personal needs are and kind of go through it that way.
Yeah, and I know we've talked about, even given the market strength, 3 really strong years, just giving maybe yourself a mental haircut over your
Yeah,
back. You know, we get so used to the high watermark. It's like, okay, well, the highest my portfolio is, I should only go up from there. But if you anticipate a decline, then you might be in a better position to view it as an opportunity. If you have the wherewithal,
absolutely.
perhaps increasing your deferrals, or looking to, if you're already maxing out in your retirement plan at work, maybe even looking to invest outside on weakness. But that really starts with understanding what are your cash needs, what are your short-term goals, your intermediate-term goals, and longer-term goals. But I love the way that you framed, Steve, this conversation around the emotional side of investing. Oftentimes we focus on the dollars and the cents and the quantitative aspect, but at the end of the day, we view ourselves as financial coaches, and
Hmm.
a big part of it.
Yeah, absolutely.
Great. I think that does it for today. Um, Thank you everyone for joining. Steve, thank you for hosting. Great
I'm
job as always.
glad to be here.
And we'll just continue the conversation. Please feel free to reach out, between now and the end of the year with any specific questions that you might have, and be on the lookout for our 2026 quarterly participant webinar series. Take care.
Bye now.